Hello, hello.
Good morning, everybody.
Morning.
We've just got a few people still joining, so I'll just wait a few seconds before I do the welcome and the introductions.
Do your members not get up that early then?
It would appear not.
Should have told them it was 8 o'clock.
Yeah, valid point. We'll still be having people joining in a few minutes, I'm sure. Okay, we seem to have stopped at the participant numbers for a minute, so I'll just I'll do the welcomes and the introduction. So welcome this morning. This is the Apricity Compliance Master Event on Specialist Lending. Main focus this morning is going to be on equity release, and I guess how to either make sure you're doing what you're currently doing well as you could be, and if you're entering the market for the first time, then how to enter the market and consider what looks good and what doesn't. My name is Christian Markwick. I head up the advisor support team here within Apricity Compliance. I'm going to be hosting the event, but I'm also going to be running one of the sessions a little bit later, where I'll talk about the FCA's recent review into the equity release market. And I'm also going to hold a Q&A session with a PI broker who will talk through what the PI market is looking for when it comes to equity release. We're very kindly joined this morning by Ash from Pure Retirement.
Good morning.
Ash is going to take the first session when he's going to go through the market as it is and talking a little bit more detail about I guess how to structure your equity release advice. Just want to make sure that everyone can hear both Ash and I. Hands up, voices, whatever it may be. Yeah, super. Because of the number of people we've got participating this morning, I don't think we'll be able to be completely interactive in terms of asking questions as we go. Please feel free to use the chat box, which is being monitored. So if you've got any particular questions, I'll be keeping an eye on the chat box as we go, and we can either then pick those up during the event if it's actually relevant at the time, or we'll pick it up after the event, because Ash and I are going to have a quick 10-minute Q&A at the end of this as well. So any questions you've got as you go, please feel free to ask them in the chat box, and we'll pick them up as we end that. Super. On that note, Ash, I'll hand it over to you.
Awesome. Thank you very much. So good morning, one and all. Thank you for taking time out this morning. We're going to kind of explore equity release as a whole. Bit of a background about myself. I think it's always good to kind of know who you're listening to. I've been in the later life space for around 12 years. A vast amount of my journey was spent in the pension investment and equity release sector, working for a company in the city, and recently moved over to Pure Retirement to focus and specialise more in equity release, kind of business development management, but also the advice sector. Really interesting sector at the moment. We're seeing obviously growth numbers again coming from COVID levels, but a lot more people are exploring this area because it truly is a natural progression for later life advice, and it really has shone with the product changes, which we'll go into a little bit more detail. There are a couple not interactive slides, but I will ask a couple questions. If you could just pop that in the chat box, I think it's quite good to try and interact as much as possible without obviously taking over on mute. And if you have got any questions, we'll feel free to do it at the Q&A afterwards. So learning objectives we'll go through today. Obviously a good understanding of equity release. We'll look at the background and obviously where the industry is heading. I'll try and give you a good perspective from a pure angle as well, which I think is really good. Bear in mind, we are a specialist provider that only concentrates on equity release. We'll have a look at the different ways equity release can help your clients. We'll look at different products because there are other products that we offer, and I'll give you a good rounded kind of section of the market. And then we'll have a look at the way modern equity release can really add value. And then a little bit towards the end is something that Pure has to offer. If you are qualified, then hopefully we'll be able to maybe help you a little bit further with some marketing and kind of support that we have with our toolkit. So this is the team. We are the largest intermediary sales team in the United Kingdom for equity release because we specialise in this area. We are heavily recruiting at the moment for more internal staff. And what is amazing is that everyone that is qualified and that is able to do equity release business has a dedicated member of staff, whether it be myself and my team that look after the southeast of England, or whether you're in the Southwest, the Midlands or the North, you have a representative that you can pick up the phone, get an email to, and it's that personal service. So if you ever interacted with us before, hopefully you've had a really good kind of, first class service. But also what we do have as well is a really good string to our cord, really. So I'll start off with the underwriting team. It says 20 strong there, but in theory, it's around about 35. The reason why it's showing 20 is because we segment a couple off to just look after the specialists, so they're not bombarded with high volume, so that you have someone tangible to speak to. Typically, in most equity release firms or outfits, you find that you'll get an email back, either a blanket statement if it's a decline, or it will get passed around the houses back to your account manager, who will then call you. What's amazing about Pure is that they will physically pick up the phone to you now. So if there are any additional questions that we need to ask, whether it be kind of lease, whether it be title issues, special conditions, we'll pick up the phone. The underwriter will physically call you, which is, I think, is really valuable to avoid any delay. And that's something really special at Pure. I'll touch on the bespoke marketing in a second. Technology for us is at the forefront. We've really kind of made a massive push to make everything a lot easier for your journey and the client's journey. The case tracking facility that we have online, it is first class. It's really kind of there to give you a really good push through on where the client is from, say, app to vow to completion and so on. It gives you a really good step-by-step. But now we have the mobile app. So with obviously COVID hitting and everyone really kind of getting the grips of technology, we've created a mobile app. So it's just adding a bit more onto it. First class customer service. So as I always say to everyone that I speak to, you get our service. So yourselves as the advisor or however your capacity of dealing with us is, you get mine and my team service or Pure service. When your client completes, and typically equity release is transactional business that we do see. Sometimes they are part of a later life lending journey, where they may have a holistic financial planner doing stuff in the background. But typically the specialists that we see are mortgage brokers or equity release specialists that just kind of transact the business, and that's kind of their journey sorted with the client. At Pure, we actually service the likes of Nationwide. So if you see Nationwide's equity release offering, that's actually Pure in the background. So we're trusted with Nationwide. We do Hodges backbook and Phoenix's backbook. So for us, a lot of our business that we do is actually servicing, and this team they're all dementia friends trained. Some of them are dementia champions. They're vulnerability specialists. So when your client transacts the business with you and they then kind of fall into our hands to look after them, if they ever need to call up for additional advice, additional lending or drawdown, one, the drawdown's paid within 7 days, which is a really good industry standard. But two, they're speaking to someone that has the right qualification, whether it be to assess if their impairments change, but also to know that they're getting really good service. And I think that's really valuable to know that your client that you dealt with is in safe hands going forwards. The bespoke marketing we'll touch on towards the end, but it's a really good offering that we have. So how have we reacted to the market changes? So we've seen the market change quite considerably over the last couple of years, whether it be massive rate reductions going from kind of the 7s and the 8s right down to last year, we hit 2.2% as our lowest product baseline. But we're looking at products to adapt with industry changes. We've won lots of awards recently for innovation to our products, but we're also looking at little tweaks just to add that client benefit. And I'll give you some examples in a little bit. We're really industry leading on support for advisors, especially over lockdown. We ran a lot of sessions, not only for equity release, but also to keep people in tune with the market. On the 28th of March, a couple of days ago, the Equity Release Council put their 5th principle in place, which basically states that every product going forwards must have a facility to overpay. So what we've done is we've made sure that all the advisors who are offering in this sector, especially that I look after, are aware of the 5th pillar that the ERC have put in. So it's little tweaks like that. It may not feel like much, but it's making sure that because we are a specialist, we're giving our specialists kind of advice over. So it's something that you can really trust. We've been really, really active in the marketing sector. We do some really good marketing kind of guides. If you've ever looked at our advisor zone, it's really, really good. So if you're ever starting up in the industry, or if you're ever kind of moving forwards and want a bit more specialist tailored marketing, there's something for everyone on the website. It's not just for people that concentrate on one area. Even if you are new to the market and just looking for, say, referral letters or anything like that, it's all available to you. So it's a really good resource to use. And we actually partnership with really good organizations. We've done some really, really kind of good stuff with the Society of Later Life Advisors, the SOLA. We partnered with loads of kind of local firms in Leeds. We're really kind of here to engage and give our content relevancy to who kind of is our audience, yourselves. As you can see on the bottom, I'm not going to go into the products, but we have 5 funding lines here at Pure. Excuse me, which is really good. So good diverse of product. And that goes into kind of the awards that we've won recently. It's something that we don't speak about quite a lot, but I think it's quite prevalent to understand who you're dealing with. Because Pure isn't a household name, it's not your Aviva or LNGs, but we are true specialists in equity release, and we do lead it. We've won recently the Later Life Lending Innovation at the Mortgage Gazette. We won Best Product Provider at the Equity Release Awards last year. The Invest in People was something that we do company-wide. So the company truly invests in their staff, so you know that you're dealing with really talented and dedicated people. And there's a couple more there that you see. But it's something that we're very proud of, and our service as well is at our forefront. So just want to kind of move on to really the market and kind of the understanding. So if I could just ask a couple of you, or just to put in your text chat, what do you think is the property wealth owned by the over 55s in the UK? Give it a couple of seconds if you could just put it in the text chat box. And to give you a hint, it's quite a lot. Good, good. Couple of answers. Oh, 5 trillion. It's the second largest asset held by that age demographic, which is a lot more than I believe everyone put, which I'm just having a look, 1 billion, 3 bill, yeah, 1 trillion. So trillion was closest, David, well done. But it's considerable. It's a huge amount of asset that is kept by the over 55s in the United Kingdom. Bearing in mind, if you put it into view, it's the second largest asset held by them, which is just amazing. And what an amazing opportunity. We are seeing higher numbers of people looking to release equity from their property for numerous of reasons. And in a second, I'll go through the ways people use their funds and spend it in the market. But the market has changed. If anyone was in the market maybe 10, 15 years ago and saw the variety of products out there, the industry has got a lot tighter. The regulations going from SHIP, so the Safe Home Income Plan, to the Equity Release Council. They've seen the pillars being installed. So the advice principles, we've had looked at more viable options. So they've created, it's a lot more client flexible. The amount of products has over doubled in the number of 2 years, I think. And 1 in 5 homeowners will look to kind of use their retirement plans as their home, as their cash machine. So looking to draw income, whether it be from an initial advance to start with, or whether it be from a drawdown facility over numerous amounts of years. But there are loads of other stats out there. 1 in 3 of retirees feel that they haven't saved enough for a good lifestyle income through their retirement. And bearing in mind, 5 trillion of wealth is kept in that demographic, a lot more people are considering it. And then obviously 7 in 10 people depend on their state pension. Typically, what we see is that kind of asset-rich, cash-poor scenario, but the market is changing, and I'll give you a good understanding of, especially with the area that I look at, where maybe the market may be moving. So we're seeing record numbers of people look at this product. So the market obviously took a turn, I think, like we all did through COVID. It's quite a hard comparison to really put in place and trying to look at numbers, because people had to go to Zoom, people couldn't do face-to-face meetings, which typically we do see in this sector. But we're now seeing homeowners, obviously the age of 55, we're seeing a 24% year-on-year growth. And obviously the wider mortgage market has also grown. So naturally, with house price increases, larger loans come from this. Typically within Pure and within our market, if you were to go back to 2018 and 19, our average release would have been around 70,000. Last year, the average in Pure was 90,000, which is attributed to that, obviously, rise in house prices, lifestyle increases, maybe looking at gifting to family because of COVID or furlough and various of reasons. The area that I look after, the average is around 210,000 release. So you can see the disparity between the Southeast and the whole of the United Kingdom, what they're releasing are. And that typically boils down to a multitude of reasons, whether it be just a higher house price value. And then there's also a conversation around keeping your pension, the pension arena, and using your house asset. And then also IHT comes a conversation as well. So the reasons why people use lifetime mortgages has always typically done home improvements and debt management. So obviously clearing debts, they're the two largest, they equivalent for about 45%. Hasn't changed much really, especially over COVID. We've seen a small increase, as you can imagine, in home improvements. But typically they are always there or thereabouts on an application. Topping up retirement income, especially lifestyle planning recently, with the way inflation is and looking at a comfortable lifestyle, especially when someone wants to take, for example, a drawdown aspect and draw it down over a multitude of years, people are looking at releasing more and cash planning in advance. Helping families get on the property ladder, that's a no-brainer. We all know, especially where I live in London, to try and get on a house price, you know, especially on the ladder, you do need the help and bank of mum and dad typically. And we're seeing greater releases, especially in the gifting area. We're seeing more and more clients look at gifting because they want to see their family enjoy it before they pass away. Typically, we see, again, with that comes the IHT question. When they're seeing a taxation specialist or their financial planner, they're looking at the ways that, okay, well, if we can get the estate below this level, the IHT is more palatable and so on. And again, that's a conversation which is more occurring in equity release at the moment, especially in the business that I'm doing in London. Paying off mortgages, we've got this IO time bomb. We all know it's here, and I think there's a study that it's going to last here for the next 10 years that we're going to see. A lot of people in that area don't have a repayment vehicle. Equity release is a really good client outcome and a good product to explain and to use, because it is lifetime. The product is lifetime and they may stay in the property. It's a great outcome. I would suggest anyone looking at has a client that has IO, an interest-only mortgage, that hasn't got a repayment vehicle, to explore equity release. Enjoy life, the typical stuff, and then also paying for care. We've seen a huge increase in domiciliary care recently, to people taking care in their homes. And again, with equity release, it's again a potential to use it for. So trends and opportunities, I think this is always a good one. We do a market study every quarter and every year. So what we have a look at is, i.e. what people are spending their funds on, which we've just gone through. But we're also having a look at the demographic that we're targeting, say 55 and plus, where they sit and a really good cross section. So 39% of over 55 stated that they're concerned they don't have enough wealth to retire on. We know this. There is a big question around, have I saved enough and how much do I need for a good, active lifestyle kind of retirement? I think people really are understanding they can use their property for this. There is a question around leaving your pension in the pension arena and taking income from your property. There are a lot of people talking about that at the moment. But you've also got people looking at drawdown pots. So we had the largest increase to our drawdown in Q4. So people looking at, one, because obviously markets were obviously in turmoil for a multitude of reasons. So the geopolitical side, obviously we won't go into it, but more and more people are accessing their further lending or drawdown pots and taking them. Also, the way rates are changing as well, because drawdown is done on the prevailing rate. More and more people are expecting, with interest rate rises and so on, that rates will start to increase, which they have. So if they can take it at the lower borrowing level, that's obviously sorting them out going forwards. Total borrowings obviously increased around 18%. We are here at Pure seeing our greatest month that we've ever had. So we are seeing the largest lending that we've ever seen by a fair percentage. That's again through various reasons, but it's really great to see that we're seeing kind of these numbers come in. And it's not just from the specialists, it's a good cross section between specialists and the whole of the market. So it's not just someone or one firm dominating the whole industry, which is truly amazing to see. And then 20% of over 55s recently questions if they'll feel more likely to take out equity release. So there are, again, a good conversation here between the two specialists in the market doing daytime television advertising. You may love it, you may hate it, it may not be something for yourselves, but they are really good at increasing awareness and driving them into your areas for truly holistic financial advice or a specialist in the area. And that's really important, because whether it be a product they don't typically understand, but they see it on daytime television, and the amount they spend on marketing is truly amazing. So how are they spending? 612 million of debt was cleared using equity release. What a fantastic number. Someone that may have an IO, an interest-only mortgage, getting that cleared, what a weight off their shoulders. And this sort of product can be really, really useful for them. 29% put obviously equity paying off their mortgage I've just mentioned, and passing obviously percentages onto families. So 23% of over 75s are looking to pass funds on before they pass away to their children, to their spouse, to whoever's obviously they're looking to put down. It's a really good vehicle to use. So typically, rate-wise, we've seen rates fluctuate and considerably fluctuate recently. I think if we take an honest snapshot of the last month, we're probably looking between 50 and 75 bips increase on pretty much the product range, and that's across the market, across everyone. Again, there's a lot of reasons for that. I'm sure we all understand what they are, but the average in the market sits around 4.26%. That's taken into account the low LTV bands that are around 3.4%, and taking up the high LTV bands with the specialist products, around the 5% band. But we've seen a huge decrease. If you take a snapshot of 5 to 8 years, you're looking at a rates around 7 to 8%. So again, another real trend people are looking at is if the client has either met the gilt-based ERC, which is the 15-year gilt, and they have achieved the benchmark and it's ERC free. A lot of people are looking at re-breaking these deals because it's a great client outcome to move them from a high APR to a low APR and still able to use the same amount of borrowing. It's just saving the roll up and obviously the compounding effect. You've also got a rates that we achieved last year of 2.2%. And a lot of people are now saying, okay, well, I'll defer until it gets below 2%. So there's another conversation. If you have got any clients or know of anyone that's saying, okay, well, let's wait for the rates to go back down. There's a huge element of cost of defer here. So what it's going to, if they say, oh, I'm going to wait for the rates to get below 2%, it's not going to go back there. The way we are in the market at the moment, we're at, say, our lowest rate is 3.29 right now. So we're well away from where we were a year ago. So it's having a look and making sure those clients are understanding that if they keep waiting, there is an element that they should be looking at cost of defer and how much it may impact their advice going forwards. Numbers of equity releases doubled. We've seen a huge amount of change. We've released a new product this year Last year, we released our Emerald product. You've got plans around the 769. So if you look on a sourcing site, whether it be AdviceWise, Air, there's a multitude of different ones out there. You will see a raft of products, which is amazing because they all have different client objectives. They have client flexibility. It's really, really good, but it can be confusing. You know, you've got products out there like Super Max Plus, and the names go on. But what I would say is an amazing feature is that they all have different attributes, and whether it be client flexibility on lending or whether it be the property criteria, they're definitely trying to enclose and stay away from the typical 3-bed semi-detached in Hampshire. That sounds good on an investment portfolio. They're trying to include more, like 100% flat roof. If you've got under a 12% gradient on a roof kind of pitch, that's classed as flat. So we've got products out there that take that. We've got CCJ flexibility. One of our products will take up to £20,000 and 5 CCJs. It must be kind of paid off on completion, but we're trying to open it up. Grade 2 listed thatched roof. You know, it goes on age restricted properties on one of ours. So you can see the way the market's moving and trying to stay away from those typical 3-bed, you know, 2 up, 2 down, 3-bed semi-detached. That sounds really nice, which is really, really good. And then obviously we're seeing customers obviously increase in the last 10 years. So we're seeing more and more people using equity release, which is great. And it's becoming more of a later life lending journey. So rather than it being, okay, it's typically asset rich, cash poor clients, what we're seeing now is people take it into their advice journey, and then whether it be at later life and using it for, say, domiciliary care or IHT planning, it's becoming more of that later life lending journey. And it's really good to see. So the types of products in the market. So the product that we offer at Pure is a lifetime mortgage. So the one that it's available for the whole of the life, it rolls up and so on. But it's good to explore the different options in there, and we'll go through them really quickly. So a lifetime mortgage is obviously a secured loan on a property that's repaid upon death or entry into long-term care. There's obviously no mandatory repayments whatsoever. There are options to overpay, and as I mentioned on the 28th of March, the Equity Release Council made sure that every product going forwards must have that overpayment facility, whether it be to combat compounding interest at whatever your prevailing rate is, or if they want to overpay, we have typically 10 to 12%. We also have a product that allows 20 or 40% over repayments. So if a client is maybe looking at funds down the line, a sale of a property or inheritance, they're able to clear that debt in a numerous amount of years rather than waiting obviously for the lifetime. So it's about client flexibility. Obviously the plan holder retains complete ownership, giving them full flexibility to live in their property. And also another pillar from the Equity Release Council is that all of our products, because we're part of the Equity Release Council, is that no negative equity guarantees are on every single one of our products. So if the client's compound effect takes over the full 100% equity, they can still remain in the property and they don't owe any more than that going forwards, which I think is a really valuable thing for the product. And obviously prospective clients need to be aware that interest rates are often higher on resi mortgages. And obviously, you know, typically what we see is this is a higher kind of loan market, and obviously interest can accrue quite quickly. So it's just highlighting the pros and the cons. Typical types of lifetime mortgages that we see typical roll-ups, which is predominantly a lot of our market. So obviously providing that lump sum straight up front, and obviously with the interest accrued in when money's released. Drawdown, so everyone can have a drawdown pot depending on the product that they choose, and this allows funds to be kept with us, and when they wish to kind of take further or take the reserve, they call up and it's paid within 7 days, and the interest rate at the time is at the prevailing rate, so whatever the market kind of rates are at the moment. You've got flexible lifetime mortgages. So these are mortgages that allow voluntary repayments to bring down the total compounding effect, and obviously take away kind of early repayment charges. And then interest only lifetime mortgages obviously allow the client to pay off a certain amount per month. And there are certain products out there with other providers. It's not something that we do, that you may get a discount if you service the interest, which is really, really good, because it encourages that kind of overpayment side, which I think is really valuable in the market. Two types that we don't offer, but are also in the market, is home reversion. So if anyone's sat ER1 or done the CII exam ER1, you'll know that pretty much every question in the exam is on home reversion, but it equals such a small percentage of the market. I believe there are only 2 providers out there doing home reversions now. But what a home reversion is, it involves actually selling part or all of your home to the equity release provider. Obviously, you can stay in the property rent-free until death or entry into long-term care, so exactly like a lifetime mortgage. But interest isn't added over the duration of the plan. The home reversion can obviously generate larger amounts for a lifetime mortgage. But obviously, when it comes to it, depending if the house increase, you've sold that percentage, so you don't own it. However, obviously, as you can see, obviously, if you sell it below market value, you're not going to benefit from any house rate increases. So if you have sold it, that did a home reversion a couple of years ago, and we've seen the boom that we've seen recently, they aren't going to be able to kind of attribute to that. So that's maybe a downside to a home reversion. Retirement interest only mortgages, or as you may know them, RIOs, aren't backed by the Equity Release Council, but again, are really prevalent in the market. So what we're seeing is a combination of your IO, kind of lifetime mortgages and the mortgage side. So loans paid off on death or entry into long-term care. So you can see the kind of transition from all of these. They have that, or the sale of the property. Interest payments are mandatory. And this is done by an affordability check as well. So where maybe you look at an interest only lifetime mortgage where it isn't affordability checked, a RIO is. And the amount that's borrowed on both retirement income and the loan to value ratio. So with a RIO, you have to pay the interest off every month. You must pay it. Where other products out in the market that we don't offer, but are through another provider, if you don't pay it, it just converts to a roll-up mortgage. So they're a different attribute, but with a RIO, typically you get a higher loan value. So a good kind of look at the market. One thing that we like to stress is that, especially through COVID, we've seen huge shift into a digital kind of interface. And a story I always tell is that I remember my nan coming to me maybe 10 to 15 years ago with the witch guide on how to use the internet. And I thought, Jesus, I'm not getting into this. I can't teach my nan, but they are so entwined with what they do now. It's the fastest growing cohort at 65 using on Facebook. They are only targeted by about 1% of typical spend, whether it be from the whole industry or from our industry. 1% is looked at on social media, but 70% of them will research you before they buy. So a lot of work that I do with the accounts that I look after is looking at your Google reviews. You may see it's such a small thing, but 70% of them that hear about you will check you out. So it's making sure that, depending on how you're engaging with the market, is that where you are, you're looking at how your reviews suit you. Have you got 10 Google reviews at 1 star? You know, that's something that they'll look at. So just be aware that there's such a little tweak that can be made, asking everyone that you're dealing with to, can you put a Google review on? And it makes a huge amount of difference. But then there's also the other sector, is that 80s plus, like something physically tangible that they can take away. So it's having that right material and that right balance, which we'll talk about in a second, about how maybe we can help you in the market. And I think it's vitally important. So, Equity Release Council. Who are they? What do they do? They are kind of the governing body for us and set a really good conduct of standards. They used to be SHIP, and then SHIP changed into the Equity Release Council. They promote a really high standard of conduct through the industry, and it's really good to see that the market that we operate in is governed exactly like some of the others out there. They provide guidance, standards, and advice, and they have their summits in May, which David Burrows, who's an MP, is the chairman as well, kind of conducts and views. It's really good. They have the client at the forefront. So with the new pillar that they included on the 28th of March, every one of their pillars has the client at the forefront, not the advisor, which is great because it's put in that client first, which they always should be. They keep up to date with compliance issues and changes. So if you get their monthly kind of bulletins, it's really good to keep up to date with compliance issues and what they're seeing, and also market trends. The data that they use and the information they provide to the market is so valuable, not only for your education, but also to pass on to your clients. Some of them want to know more, and this is a really good resource to use. So if you log on to the Equity Release Council, have a look. But also, if you are active in the space and you're not on the Equity Release Council register, do register, because clients will type in Equity Release. They'll see the Equity Release Council, they'll then click on Find Member, and you may find that you get 2 a year, you may find you get 10 in a year, but it's free and it's a really good tool for someone to find you. Again, if you use Solar or anything like that, if you're a Society of Later Life member and you've got, say, ER1 and CFA, the care qualification, then again, that's a really good tool to use. So vulnerability, looking at kind of TCF and what the FCA define, but then also you look at occasional paper 8, which they've drawn. So vulnerability and kind of social lending and is a big thing for us. And you may have seen this before, but I think it's really valuable to touch on it again. And what is vulnerability? So a vulnerable individual is someone who, due to their personal circumstances, is especially susceptible to detriment, particularly when a firm is not acting with appropriate levels of care. Now, I am a dementia champion, a vulnerability champion, mental health first aider. It's something that we really believe here, and it's understanding what vulnerability is, because a first-time buyer could potentially, according to the FCA, be potentially vulnerable for a short period of time because their first property, for example, marriage, death. There's a whole range of different vulnerability sides, not just elderly, age, bereavement. You know, typically that we think in the market, there are a multitude of reasons, and especially if we're thinking 55 plus, you know, that sort of age range is the highest divorce rate in the UK. But then you've also got remarriages in an elderly age, which is one of the greatest growing cohorts, and so on. But it's something that we need to be aware of. The Equity Release Council have a really good guide. If you've never seen it before, they have a kind of checklist for vulnerability for equity release, and I would urge you to have a look at it. But vulnerability situation can only be once, or it could be for a long-term period of time, and COVID was a great example for this. We saw obviously the kind of whole country shut down and closed down, and people who were lonely became vulnerable in a greater capacity. Care homes completely changed, and it was a huge issue, not just for those big places, but also for individuals like us. And obviously we can have episodes of vulnerability. So if you are dealing with a client, and especially from a mental cognicity point of view, you know, are the right barriers in place? Is there an LPA? Have we got the right people in the right room? Have we got the children in the room? What sort of conversation needs to take place if we think, you know, diminished cognitive impairment has occurred? And there's a huge raft of different questions need to be asked. But as a lender, we will assess most applications, and if we speak to any clients through our servicing team that have any issues, we're very good at picking that up and red flagging it. So the FCA obviously identified 4 key drivers, and we've all seen this before, I'm sure, but health, lifestyle, resilience, and capability, sorry. And it's really good to have this at the forefront of every bit of business that you do. Some groups obviously likely to change characteristics, you know, the over 75s, those unemployed. So furlough was a huge one. We obviously saw a huge amount of people take equity release, further withdrawal with further advances for their children that have lost their jobs through furlough, and so on, really. And that makes them vulnerable and susceptible to obviously change. So regulatory issues, obviously we're having a look at kind of consumer values and customers here. So keeping it simple, the phraseology and what we use, especially in Dementia Friends, is that using the right terminology and keeping it simple, you know, not confusing them. I think to take out a flexible access drawdown and to read the KFI, you need a degree level of understanding to read it. And it's the same through most financial products, but it's making it jargon free, you know, using, as they say, plain English, helping that kind of involve the right people at the right time, you know, whether it be bringing in the children, whether it bring in, you know, a friend to help them. And you'll find that especially with Zoom, they'll be more easier to get hold of, especially where you've got children across the world. Having that Zoom and that Teams meeting is just amazing. So Actuaries Council, and having a look at the checklist, it's really, really good, especially for vulnerable clients, and knowing that it's come from the Actuaries Council and from your compliance standards, it's there. I think it's really valuable, and make sure you don't miss the opportunity to see it. But they've increased it from 12 to 24 questions, which may seem a large increase, but it's ticking off every box. We're kind of asking customers to engage and speak to specialist advice, whether it be solicitors, a qualified person if they don't have a power of attorney, so an LPA. It's making sure that every box is ticked, and then also having a clear process to identify if the customer has suffered a life event, which may leave them vulnerable. So whether it may be if they have got an equity release policy, joint policy, and their partner passes away, you know, are they taking money because someone's passed away and their income's dropped? There are lots of questions to tick off, and that the checklist really does cover it all. So just to summarize the issues, obviously with the regulatory side, obviously there are numerous degrees of vulnerability, and it's making sure that we consider them all and discuss them. It's important to assess customers' mental capacity through this process. So if they start repeating questions or start asking the same thing back again, or, you know, you'll be able to pick up on those key identifiers, but it's making sure that you understand them. Also using the framework and protocols that we use for vulnerable clients. So whether you have an in-house policy that you've created since Occasional Paper 8 came in, it's definitely there. And then obviously always maintain the awareness and keeping that kind of active to make sure that we accommodate the right clients at the right time. And then obviously we're always here. We've got a really good dedicated team. My team in the office are truly amazing, and they'll always be there to help you out. And I think using the tools that we have in the market, it's not just us, you know, we are not the only provider. Make sure you utilize in your network of BDMs to get that information. If you're looking for more of a product session and want to understand the key USPs from every product provider, just make sure you get in contact with your account managers, and it's utilizing the network that we have. So I mentioned we have a really good free resource and advisor kit. The toolkit that we have, we provide every advisor with a budget, which I think is amazing. But what we also have is the expertise on what works. So we have huge raft of options available, whether it be educational guides, so the brand health check, which we've been doing recently. So our head of marketing has run an amazing Zoom session, which you can kind of have a look at on our website. We have bite-sized educational pieces, whether you're looking for social media changes, keywords that people want to use, maybe Google keywords, digital templates. So you'll see if you're active on LinkedIn, we all have really good LinkedIn kind of headers, footers, adverts that we do. The LinkedIn post that we offer is all done by a marketing team, and you can get access to that. We have customer facing YouTube videos. So we do not only what is equity release, it's tools to help you, and that we've created over a period of time. We've then got printed templates. So every advisor that is qualified in equity release or has the CMAP equivalent or equity or ER1, we will give a £200 budget to use within a year's period. Now we can create, it can be white labeled to your kind of own fonts, kind of anything that you want on there, we can kind of put on, and we can give you pull-up banners like the one behind me. We can do printed templates, referral letters, the list goes on. It's a really good bespoke marketing tool, which is available on our website. So if you go to pureretirement.co.uk, click on marketing, and you'll see everything there. Whereas you can see at the bottom, what we have is obviously the email address that you can email. So if you want to get any further information, the team are there and they're really, really good to use. And then case studies. I think case studies are massively important. We're creating some new ones around IHT and gifting, but the 15 on there at the moment are really, really valuable. And if you ever want to know a little bit more, it's there for you. We have the mix and match service. So if it's something that you want just to pick, the kind of stock levels, which will get it to you quicker, you choose your header, choose your text, choose the image, and then we'll send it to you. Events and support for advisors. We're always doing webinars. So if there's anything that you need webinar based, we are always available. We have pre-recorded webinars. We have live webinars, which we send to the market. So if you're not registered with us, please do register with us so you get all the updated information. We give you the insight blog. So what we have is not just only on LinkedIn, but we also have on our website, on other social media platforms, a constant blog that we're updating, whether it be from someone like myself, or whether it be from our CEO, Paul, or whether it be from an industry professional, maybe like care. We do a lot with my care consultant to have a look at maybe where domiciliary care might fit in. And that's where it's led by, and it's free. You don't get much free, and it's something to really utilize. And the quarterly reports that we do as well are a really good insight from a true specialist that's taken our information and putting that into a palatable document for you to read. You can give it to your client as well. That's totally fine. And obviously everything that we do, if you request it, can be CPDable. So having a specialist CPD to put on your CPD record, I think is really valuable. I mentioned obviously about the quarterly report and keeping up trends. I would urge you all to go and have a look. It's a really good 4-page document. It's infographic as well, so it's not just 4 pages of text. It gives you a really good insight into the market and where typically a quarter, moves. We typically see 2 seconds. Sorry. We typically see the market have trend sections between Q1 and Q4. The recent one of Q4 is really good to see because we had one of our greatest quarters, and it will show you percentage-wise of people that we've either surveyed or questioned or even looking into applications and when people are spending their funds. And I think it's a really good insight for anyone joining the market. Brand guides. If anyone's getting into the industry and they want to know maybe how to target over 50s that may have not done it before, maybe you're a mortgage advisor and you haven't really targeted that later demographic, we can help you and look at your brand strength. We can have a look at maybe as there's simple changes that you can use, the color of your text, changing the tone and the imagery just to reflect a different age demographic. We can help you with that. And the full brand report is available on the website, which is a great document to go through. I use it constantly and it really adds value. And I would suggest anyone that's going to start in this market or wants to adapt to this market, really have a look because it's a free resource to use. And as I mentioned, we are specialists, we know what we're doing. Do take our advice on it. Now, questions I will say, what support do you find is most useful from Pure? I know it's quite hard to interact, so maybe I'll leave this for part of the Q&A in a second. But I think it's really good to understand what support we can give you. Is it something that we're already doing? Have you engaged with us previously? Is there anything that we could add value to you that we maybe don't do? I think we'll leave that for the Q&A because there's too many people in the chat box. So if we want to just add on an extra 5 minutes to the chat, and then hopefully we can talk about it, if that's all right. Christian?
Couldn't get my video to start then.
Oh, sorry.
Ash, thank you very much. That was very informative and insightful. I guess before I go through any questions that I've got, as you say, has anybody else got any questions? Has anybody else got anything particular they'd like to raise, either in based on what Ash has just talked about, or something that maybe you had as a question prior to us starting? Can't believe we're 40 people. There's no one's got a question. Okay, Ash, I've got a couple for you.
Go for it.
Couple of things that struck me, and actually this isn't a question, but just a comment, and something I'm going to touch on a little bit further is the vulnerability side of things, and the Equity Release Council. Can't stress enough how grateful, and it's good to see how you're promoting those side of things, because this is serious stuff, and this is stuff we've got to get right as an industry or as a profession. And there's so much guidance out there now that advisors shouldn't ever feel the need or feel left out and not knowing what's going on. So couldn't agree more, and we'll talk a little bit more about that in my session. And obviously I'm very aware that you guys do a lot with regards to vulnerability training and assessments and stuff. And for those clients who are Apricity clients or are part of the Verve group, you'll know that we've got some vulnerability testing built into our system as part of your annual compliance testing. But I do regularly hear, and I'll be honest, promote the fact that Pure do a lot on this. So there's a lot of people out there who I know are using that as an added extra. So yeah, make the most of it. Ash, you touched on a little bit about, I guess, the different uses that you see for equity release, but can you talk a little bit more about how you see clients, or how clients have maybe started to use the funds they're taking from the equity release, the funds differently, and how that market's changing a bit?
Yeah, it's, as I mentioned, typically we see people use it for two reasons: debt consolidation and home improvements, and they will always be there or thereabouts. We've seen home improvements increase through lockdown. Traditionally, people are staying in the home more and more and seeing stuff that they don't like, so they want to change the property. But what we're seeing is a huge increase. Now, one thing I want to highlight is that you can use equity release as a purchase. And what I mean by that is you can purchase property and equity release it. Typically, we see about 0.4 of our business going into this area. Over the last year, we've seen it equivalent to about 5 to 6%. So it doesn't sound like a huge proportion of business compared to 24% for, say, debt management, debt consolidation. But if you look at the way the market's moving and the fold on that compared to what we used to do, more and more people are doing that. And that's mainly down to understanding, which is great. We're seeing more and more go into gifting. So gifting at the moment is about 9% of total lending that we do. And it can be a multi, we don't typically see someone that wants, the release for one thing. Typically, we see 2 to 3 elements on there, whether it be debt consolidation, lifestyle planning, and a 3-year kitty reserve, sort of, kind of cash flow planning for 3 years and then withdrawing further. The way people are utilizing funds are becoming more and more. Obviously, we don't allow any investment use for the funds. It cannot be anything like that. We are very, very, from a compliance level, we are very keen to understand the true use of funds, and we will dig into it if we don't feel that it's applicable. If we feel that, there's been a mistake on the application form, we'll call the client, the advisor, and say, what's this? And they change their excuse or anything like that. We'll red flag it. We are very hot on it, and it may be seen as intrusive, but we are doing the right thing for the client and making sure, because we are dealing with a high risk product. Don't get me wrong, equity release is high risk, and that's the way it's defined. I think as a company, we always do responsible lending, and it's a forefront of the company. I think looking at the way people use funds is really important. And I think anyone using us, and especially from a compliance side, you know, we are looking at what people are using the funds for. And if it looks scrupulous or we're not happy with it, we will question it. And I think that's a really good thing. But the funds, way people are using funds are ever evolving, and they will ever evolve. I think, and I do see the product being always typically for asset rich, cash poor, for people that haven't saved enough in retirement, and that will be the main use of the product. But what I do believe, especially in certain areas, is the IHT side to increase. It's the understanding of how a vehicle like this could be used to gift early, I think will increase. And I really do believe that whether you gift early or take it below 325 or whatever you do, I think that enjoying your kids, enjoy their inheritance whilst you're alive, will become a lot more prevalent, especially with what we've had with COVID recently.
Yeah, I agree. And actually, we're having more conversations with firms around the compliance side of things when it comes to the gifting piece and understanding how that works. Just in terms of the purchase side of things, ironically, it was your colleague Hattie who opened my eyes to the purchase or the use of equity release on purchase many years ago now, probably 2016, 2017, maybe just when she joined you guys. Just for anybody that hasn't used it or doesn't know about it, how, you know, in very basic terms, how does using equity release to buy another property work?
Cool. No, that's fine. So what we have is, sorry, I'm just getting this off. So if someone purchases a property, and that's why estate agents are really good, professional connections as well now. What you have is you can release money from the property that you're purchasing. So whether it be, say someone's downsized and say they're buying a house for 200,000, they bought the property but then need funds, we can equity release on the property that they're purchasing. So what we can allow is that someone who is maybe purchasing a property but they need to have additional funds or want to equity release on the property that they're purchasing, they can do that, and it's very quite clean cut. It's just basically they're using the property that they're purchasing to do equity release. Obviously, additional checks, and we know how long it can take to do a purchase. So, you know, we then get into a conversation about validity periods, because you know, if anyone can complete on a property in 42 days, I'd take my hat off to that conveyancer, and I'd give them every bit of business that every house purchase that I bought. But it's a really good vehicle to use if someone is purchasing a property and needs equity release as well. So that's why if you do have professional connections in the estate agency world, they're really good tools to use if they're someone over the age of, say, 55 is purchasing a property and they need to equity release it afterwards.
Okay, that makes sense. We've had a question coming from David with regard to, are there any limits on the modifications or changes that can be made to properties, e.g. ramps, chairlifts, etc., that may reduce the value of a property, I guess, once you guys are involved? Yeah,
so we obviously look at saleability. We understand that home adaptations have to take place. If any adaptations take place, we just ask that you give us a call and just ask. We're quite frank in what we say, but there isn't any kind of limit on modifications unless you're completely changing the property, like putting a flat, you know, a driveway sloping completely, and it changes saleability. But anything that looks and changes and reduces the value of the property won't want to be done, basically won't be allowed. So it's vital. So if you are making adaptations to the property, to ask. There are no limits on it.
Okay. Rob has asked about ERCs.
I've got, can you use equity release for buy-to-let properties from Ian?
Okay.
Not through us. There are companies out there that allow it. So you can, on a buy-to-let property, I'm not too sure, maybe LNG, I think, but there are one provider out there that allows it.
Okay. Different question was, early repayment charges are an issue. More clients are opting for fixed as opposed to gilt-based. What's your view?
Yep. Gilt-based, we offer one product with gilt-based, which is Heritage, which is obviously funded by Just. And if anyone knows the market, Just obviously offer variable ERCs. I believe in fixed ERCs. I believe that advice when you're giving your suitability report, giving your client that end date is really valuable. I really like on advice giving the client the exact figures of when the product will become ERC free. On guilt-based, you have to beat the benchmark, which at the moment it has, which is great, but typically it doesn't. So I believe, my view is that most products will keep moving to fixed ERCs because it gives that client that end date of when the product will become ERC free. And writing that in the suitability report, I think, is really, really important.
Yeah, I think from a disclosure basis, and also a client understanding exactly what they're entering into, and especially back to the point of this being a high risk piece of advice and high risk lending, and the fact that we are likely to be talking about vulnerable clients. I think the clearer we can make things for people, that's not to say, you know, that the other options aren't available, but the clearer you can make things for clients in that circumstance, when in reality, you're potentially talking about people who aren't necessarily investment savvy and aren't understanding the nuances of these. If, you know, if we're talking about people who are potentially a cash, you know, asset rich, cash poor, or the home is their only asset, then they're not likely to have been around financial advice, financial products a lot during their lifetime. So there's a lot of confusion, which is why this becomes one of the biggest risks, you know, that advisors get into when it comes to the advice they provide.
That's it. And, you know, our ERC kind of year cascading map can only be between 8 and 15 years. If the gilt base never beats the benchmark, then it's never going to be there. You know, I think having that end date, as you mentioned, just for client simplicity, you know, giving them that freedom to know that in 8 years, if they do decide to change, and then it's even talking about downsize and protection. So 3 out of 4 of our product lines have downsize and protection included. So they're all 5-year downsize and protection, which means that if anyone's been in the property for over, has the contract for 5 years plus, and decide to move, and the new product doesn't fit in our property criteria, we'll allow them to redeem it ERC free. So they'll have to repay, but it'll be ERC free. Okay, and it's again that bringing that client flexibility on. But I believe in fixed ERCs.
Okay. One more question that someone else has got, and I've got another one for you as well, is do Pure offer enhanced percentages due to bad health? No.
So so I worked a partnership in Just for 10 years, 12, 11 years. That's their IP. Their USP is Just. Medically underwritten longevity data is their bull, and that's who offer that contract. So even though that Just are one of our funders, we don't offer increases due to ill health.
This is me giving my own opinion, but I guess that's because Just have got the data through the annuity side of things, in terms of they have the ability to get into that market because they have the services and well, I guess the data, full stop. They are able to do that because that's their bread and butter.
So their greatest asset is their longevity data, because they've got annuities, but they've also got long-term care. Mm-hmm. So they've also got that straddle from 50 up to 100 plus. So the data that they've got for medical underwriting is truly magnificent, but that's their IP.
Okay. Question I've got for you, this is something I've seen both personally in terms of advisors asking me for some thoughts and just generally, is how does sort of geographical location kind of alter what people can do? You know, what are the kind of minimum house prices, minimum lending limits? You know, how are there going to be any restrictions that certain people in the country find themselves in terms of what they can and can't do?
Oh, that's a long conversation, that one. Yes, you're right. So the average house price roughly is around 224 in the UK. That's typically what we see. 224,000 is what we see averagely in the UK. As I mentioned, the average release that we see is around 90,000. But it depends on LTV bands. You know, we can release anything from say 23% up to 61.5%, depending on age. So everything that we do, so where maybe Just might do their medically enhanced, what we have is LTV bands for age. So at age 85 is the highest LTV band. So for example, on our Emerald product, they can release up to 57.5% at 85. plus cashback is optional. So they can take 4% cashback, which is obviously up to 61.5. But every different LTV band will offer a different amount. You've then got property criteria, which comes into it. So I live in London. Obviously, commercial is a big question. So near commercial, near schools, different property, different of our products will allow different kind of uses, more flexibility on, say, close to schools, close to places of worship. But we don't really have a regional based system, if that's kind of what you meant. We have something called flexible pricing, which it has 500 price points in each product, which basically means that the API frame driven the data underneath the sourcing systems is very clever. So if the funders want to be more aggressive on a certain postcode, when you put it in, it will be very intuitive.
Okay.
And obviously there are certain areas which have higher growth on property value than others. We know that. There's no point beating around the bush on that. Certain places of the UK will have higher growth, but also when the market turns, if it ever does, they'll see the greatest losses. So it's depending on where they want to feel comfortable in.
Okay, that makes sense. I saw a hand going up from Andrew. Is that a direct question, Andrew?
Is it regarding the when it comes to selling the property?
Yeah, I don't have.
I've got that. It's a direct message. Sorry.
Okay.
Yeah. Shall I read it out?
Yes, please.
Yeah. When it comes to the sale of the property, who is responsible for the eventual sale, and what safeguards are there to be it's sold at a fair price? So, if someone passes away or goes into care, we say that they have 12 months to sell the property. It's not hard and fast, as long as, that's the framework we like to work within, but we understand sometimes it can take a longer period of time depending on the property. Regarding safeguards, obviously that's down to, the kind of whoever's inheriting it and so on, that we have to repay it. The family can sell the property. That's it's not something that we get involved. We don't actively have like an estate agent that we use, for example. So that's not down to us, but we say the loan needs to be repaid 12 months after death or gone into long-term care. But as long as you're doing the right things, i.e. it's on the market, the viewings are happening, maybe it's a specialist sort of property that takes longer to sell, is it in probate and so on, there's just certain things that need to be done. But we're very much, when they say safeguards, obviously, we don't implement the safeguards really there. We just obviously expect it to be repaid, but we will work with you within the timescale. So it's not that we call you up every week saying, can you repay it? Can you repay it? Can you repay it? So we are quite cautious with that.
Actually, just talking about specialist properties, I know you talked about geographical situations and certain areas, but when Rob's asked another question is, what about living near a working farm? Also, how many acres do you accept, and provided we'll only accept 5 acres? And then for clarification, that the value is based on the 5 acres. Yeah,
no, fully understand. So really, really quick snapshot. The only product that we have is called Classic, that will allow near a working farm. It's wholeheartedly down to surveyor comments, that one. So they will accept it from a funding level, but it depends on what the surveyor comes back with their comments on the working farm. So it's a conditional base. We have 4 funding lines. Classic will look up to any acreage now, but will only count for 5 as stated below. So a little bit like the Aviva side. Sovereign will look up to 20 acres and will take the full 20 acres into account. Cannot be agricultural. We'll take like stables, for example, and so on.
Okay.
Our Emerald product is 7 acres. And our heritage product is 5.
Okay. So I guess the reality is, if you've got situations like that, it's a conversation with your
yeah.
account manager.
We won't go through the products, but if anything gets something that's a wee bit different, we have a product called Sovereign, which I call weird and wonderful. And what I mean about that is that it's very flexible on property criteria. 20 acres, 20 grand CCJs, 100% flat roof, unadopted roads. The list goes on. If there's a property which is a wee bit different and a little bit outside the norm, it typically fits within that product.
Super, that makes sense to me.
Wicked.
Well, look at that, bang on time. If no one's got any further questions, I'm going to suggest we break for a quick kind of 10-minute refresher. I'll then go, we'll come back. Ash, well, thank you now, but I'll be coming back to talk around, I guess, the more compliancy side of things in terms of the FCA findings, extra release counsel, vulnerability, and then, as I say, there'll be a Q&A with Thomas from UK Global to look at the PI market. Ash, thank you very much. That was really enjoyable.
No, you're welcome.
Lots of content, lots to go through. Obviously, if anyone's got any specific questions, then we'll be sharing contact details at the end of the session anyway.
Amazing. Well, thank you very much for the time. And yeah, I hope to speak to you all very soon.
Fantastic. Thanks, guys. Let's see you. Let's come back up sort of 10-2.
Cheers.
Brilliant. See you in a second. Welcome back, everybody. I'll give everyone a couple of minutes just to make sure they're settled and back okay. Can I just check people can hear me?
Yeah, can you hear me?
Recognise that voice. Morning, Andrew.
You okay?
Yeah, very well, thanks. How are you?
Yeah, all good, thank you.
Good, good.
Yeah, we can hear you.
Fantastic. Okay. This session is, I guess, trying to talk around what we see on a daily basis as far as files that are put together, which obviously come as part of applications and then file checks, and also the feedback that we've had from both the FCA in the review that they did in 2020, which has formed a big part of what the Equity Release Council has now put together in terms of what they deem to be, good practice and how they would suggest firms approach this market and giving advice in this area. So it's all based on fact in terms of stuff that's been seen. It's not theory-based advice. It's this is information that the FCA did a review in 2020 when they reviewed a number of files, a number of firms, and this is the information they took from that. Now, I'm more than happy if people want to have a conversation around this as we go through it. I've got 40 minutes to go through this session. I think Tom from UK Global is going to be listening in as well before he and I have a Q&A around this area and to talk about what the PI market looks like. But I'm more than happy to open up the floor here. So if people want to use the chat facility as we go, I'll make sure that is open for me to have a look at. And really then to talk about anything in particular. Equally, if people want to put their cameras on, put their mics on, I'm more than happy to have a conversation. So just a little bit about me. My name is Christian Markwick. I head up the advisor support team here within Apricity Compliance. Been in the industry for 22 years now, and I was an advisor for many, many years, and then decided to step back office and now work closely with a number of firms, a number of people on here, which I'm pleased to see this morning. Work closely with firms on how to get things right, which is the whole point of how we approach things at Apricity. This isn't about a tick box mentality. It's really how do firms get this right so that we protect your business and hopefully in time make the business more successful and more profitable. So the key things here for me are, what's missing. What did the FCA find? Let's start with what the initial the exploratory work gave us. So as far as that was concerned is there's been a huge growth in the lifetime mortgage market. So Ash talked about it. The general, I think if you're talking to anybody who's working in this market, no one's been busier when it's come to number of inquiries that people are taking. Now, whether that's the impact of COVID, whether that's the growing trend in terms of house prices, whether that's the fact that people haven't potentially planned for their retirement as well as they might have hoped, who knows, but the market is growing, which is great for you guys. But it also means we've got to get things right because this isn't just a small piece of the market that's going to be left alone and no one's going to notice what's happening. Both the FCA and the Equity Release Council are therefore keen to ensure that consumers are receiving suitable advice. Now, there's a big I guess a big difference here in terms of suitable advice, where you go, well, actually, I've done what I need to do. The file is compliant as far as disclosure, in terms of, I've done what I need to do. With regards to documentation side of things, the big change here, and I think this is where especially if people have stepped out of the mortgage market and started to work in the equity release market, this is where things will differ, is really starting to look at personal circumstances. Now, anybody who works in the investment market, the pension market, the defined benefit market specifically, it's really around understanding what the client's personal circumstances are and why equity release is the most suitable option for them versus other options. I'll talk a little bit more about that as we go forward, but that's, I think that's the big step change for lots of people who've maybe been involved in the mortgage market previously and are working on instructions to actually then working in the equity release market, where really you're looking at clients' personal circumstances and tailoring the advice to that. Vulnerable client, we talked about it in the first session. I don't think we can ever have too many conversations around this at the moment. This is a key area that needs to be given a lot of time and attention. We've run numerous sessions for firms on vulnerable clients and how to assess them, how to address them, how to document it, what your options are, what to look out for. So if anybody wants any further clarification on that, I'm more than happy to have a conversation after the event or at some point. But this is something that you guys as businesses and advisors need to get right, because it's something that I think, if it's not done properly, will come back and bite people in the future. Now, whether that's clients themselves saying they made bad decisions, whether that's their beneficiaries saying they've made bad decisions, whether that's claims management companies, and let's not ignore the elephant in the room here. There will be people out here that are looking to make a buck. And the reality is, if they can find a hole in your file where they don't believe you've covered something off as well as you could have done, that is likely to be picked up by somebody. So, let's just protect ourselves here and make sure we've done as much as we should do, and also protect the clients. The clients come first here, but also you've got to protect yourselves in this. Evidence of suitability. So actually, whilst we would never want to see, let's use old language, a reason why not letter. One thing that, again, this is the difference between maybe looking at the mortgage market, is actually really documenting what other options were considered. So what other ways could the clients have achieved their objectives without using equity release? Now, that's a step change for a lot of people, because it's almost counterintuitive to go, well, this is the market I work in, why would I look at other options? Because of the nature of the product, because of the high risk area of it, it should almost be a product of last resort. And because of that, you've really got to be able to document exactly why you've gone down this route versus looking at more simplistic options that may be available to you. So again, this comes back to understanding the client's personal circumstances and understanding what their objectives are, to then look at what options are available, and then to be able to document why you've gone down this route and why you've not looked at a couple of others. So again, this is a big difference, I think, between looking at standard everyday advice to stepping into what is a high risk area. So what does good look like? Let's start with the good. When sold correctly, equity release products, have a really great piece to play in the market. We've talked about it in terms of, and Ash touched on this a little bit in terms of how he sees this being used, but obviously repaying existing mortgages where the client can't afford the repayments. Carrying out home improvements, household repairs, adaptations, all the rest of it, fairly standard. The consolidation of debt, Ash already said at the start, and by the way, this is what the FCA found. These are directly taken from their review that they did in 2020. So these are what they found were good outcomes. So consolidation. Obviously, if clients looking to take on a flexible retirement, I noticed something this morning that came out that says there's a certain percentage of people that are now talking about never retiring or retiring much later than planned originally, because they want to have that flexibility to be able to work as and when they want to. This could be an ideal way to do that. If client doesn't have the pension funds available to be able to do some sort of flexible retirement, then this could work really well for them. I think the other part there, and I guess the other thing we didn't talk about, and again, this is where you're looking at purchases. And so, the FCA probably didn't review it at the time, but I've seen a number of people now starting to use equity release in a similar way to they would do, a more standard type funding. But obviously, there's no repayment. There's no repayment needed on the back of it, or no monthly repayment needed on the back of it. let's look a little bit more detail at to what they found were to be the poor outcomes. So on this side of things, we're starting to look at the pitfalls where people maybe aren't going in as much detail as they should do. So we've got younger consumers not being told about their borrowing options. So basic traditional mortgages. So whilst these could be cheaper and more flexible, given the difficulty in predicting consumers' future circumstances and need for 30+ years. So this is really making sure that you will have had a conversation. There's absolutely no doubt in my mind that anybody is providing extra release advice without looking at more standardized mortgage options first. But the file isn't telling that story. And there aren't details in terms of the conversations that were had. So again, because of the nature and the longevity of this product, really make sure that you've documented every single conversation you had and every single piece of or other option that were considered. So short-term benefits. So obviously consolidating debts and freeing up cash and wiping out the long-term, the long-term debt is great, but obviously the benefits of doing that over the long term, the cost of extra release will wipe out the benefits of it. So and this is again taken directly from the FCA's findings. In most cases, interest roll-ups, so rather than being paid monthly, meaning the interest compounds over a number of years, so the debt can actually be several times what was originally borrowed in the first place. This is then particularly damaging when consumers have actually have surplus income that they could have used to repay the debts rather than consolidating them. So something that comes out of this for me, and we see this quite often when we're doing file checks, is it still feels like advisors are and feels, not saying that's what happens, feels like advisors are taking instructions. A client has approached you because they want to do an equity release, and you facilitate that. Rather than actually detailing as an advisor, my advice would be to do X. And we've looked at the options of doing these things. So we've done stress testing, we've looked at cash flow, we've looked at ways and means of paying the debt in other ways, rather than taking the instruction, which is potentially the easy option. And the issue you've got here, and again, this is what the FCA have said, is there's a conflict of interest here. Because obviously, from an advisor's perspective, you're going to be paid a procuration fee or a commission for providing equity release. And that conflict will always be there. Now, in this instance, we've started to see a number of firms start to bring in fees and fixed fees that are based on the work you're going to do, rather than being paid on a contingent basis, which is if the advice goes ahead. Because obviously there's an awful lot of work that goes into equity release. And if you find that doesn't go ahead, well, you've put that time in for nothing. And that then produces a conflict. So the FCA have actually come out and said that they feel that, and this isn't dissimilar to the defined benefit market, where actually if you're charging a fee, that conflict is vastly reduced. Now, that's not to say that fee can't be refunded, or there are ways and means of the client getting that back if they go ahead, but it means that the conflict of interest as far as you're concerned is vastly reduced, if not removed completely. So again, let's just think about the perception, and let's imagine this file was reviewed in 10 years' time. How can you document that actually you did what was best for the client's interests, rather than it appearing that it was best for you, which is the fee, the procuration fee. The other element here, and we talked about it in the earlier session, is customers paying substantial early repayment charges of tens of thousands of pounds only a few years after taking the loan because their circumstances have changed. Now, this directly comes back to understanding the client's circumstances. What are their plans? Are they due to inherit money potentially in the next 10 years? What else is going to happen? Are you asking as many questions you can do about that client, their family, their circumstances, their finances, their objectives, everything, absolutely everything, so that you can be absolutely clear that this is the right answer for them and that there aren't other ways of doing this. Because obviously, if we find a situation that in 5 years' time, or under 5 years' time, in terms of what Pure was saying, you've got the situation that the client's going to be paying a fee on this. So let's be very, very clear. This is about you documenting the client's circumstances as well as you can, so that you are then able to advise that this is the most suitable way of the client achieving their objectives. I think there's a slight misconception in terms of consumers making sure they fully understand both the short and long-term impact of equity release on their finances. I think there are, in some instances, lifetime mortgages seem very similar to traditional mortgages, but the risks involved are very different. So again, it's making sure that both the client and the advisor understands the differences. It really understands the differences. and that consumers have got the time to take at every stage of the process to make sure they fully understand the implications of their decisions. Equally, it's more important that the firms and the advisors involved in this help and guide consumers to make the decisions that are in their best interests, rather than taking an instruction. And I think that's a very, very key factor here. This is down to you as the advisor to be giving advice rather than taking an instruction, because you are the most knowledgeable person within that room. So again, making sure that that is clear as to why you're making that recommendation rather than taking an instruction. I don't know if anybody does any extra release advice on an insistent client basis, but again, that for me would be a very risky area, and we'll talk to Tom about that a little bit later with regard to PI and how they view that, because I think the insistent client market for any type of advice is getting a lot harder to justify when there are so many options available to clients to go direct to somebody else without needing for you to be involved. So direct to consumer advice is, direct to consumer market is growing rapidly. And with regard to the final piece here, it's really obviously consumers limiting the ability to further release cash or downsize in the future without paying all of the funds back. So again, understanding the product, really what we know, does the advisor and the client understand exactly how the product works? Ash was talking a lot earlier about the different types of products and how they work. And I think, the market is growing rapidly. So we really, really need to be sure that you guys and the client understand exactly how these products work, rather than slipping up and finding something out in the future. The big area here, so the FCA found 3 significant areas of concern about the suitability of the advice provided, which obviously we then considering the increase of risk and harm to the consumers in the market. So the 3 areas are insufficient personalization of advice. So again, we touching back on the point that we talked at the start here. Advisors aren't, in many cases, personalizing the advice they're given and are working from a templated suitability report, potentially a fact find that's used for mortgages rather than equity release, and really aren't going as far as is needed to research and to document the advice that's been provided. Touched on it earlier, but you really need to be looking at what other options were considered and documenting it. Insufficient challenging of customers' assumptions. So again, are you taking an instruction? The client thinks something, they've had a conversation, they've read it on whatever it may be, and they come to you and say, this is what I want, and without any further challenge, the advice is provided, and the client walks away with an extra release mortgage. And then obviously lack of evidence supporting the suitability of the advice. So there's a common theme here. This is all around you as the advisor being sure that you have enough information on file to justify that advice. And I think this is the common theme. This isn't unusual. This is any when it comes to high risk areas, and I've talked about defined benefit a few times, but they are very, very similar circumstances. So very similar situations in terms of what the FCA have said, and the PI market is very, is not necessarily scared, but is very wary of is the lack of personalization of this. So to put a little bit of context around that. So we talk about, I guess, what advisors can have, but so in reality here, we talk about not sufficiently accounting for the different financial circumstances of their customers. So for example, those in their 50s and still working versus those who are retired and on a fixed income, and the impact this has on the options available to them. Advisors wholly relying, I guess, on the substantially on the key facts illustration to show customers the long-term costs and implications of the lifetime mortgage. In better examples, the FCA found that advisors were supplementing the KFI and taking time to ensure customers thoroughly understand the costs and implications. So taking it a step further, breaking it down, actually putting it into something that is far easier for a client to understand. The impact of debt consolidation was not properly explored. So again, all too often, the default assumption was that extra release would be suitable with an alternative solution to discounting or given little consideration. So what other options were looked at? Why wasn't a personal loan? Why wasn't a secure mortgage? Why wasn't a second charge mortgage, if necessary, used with shorter periods, which means that actually the client's long-term debt isn't rolled up and doubled, trebled, whatever it may be. So again, all of these things need to be taken into consideration. There's actually a Cobb's rule detailing the kind of factors that you must take into account when doing debt consolidation. And this should still be part of the extra release transaction. So again, don't fall foul of thinking, well, this is extra release, I don't need to do the stuff I'd do if it was a mortgage. You do. There's very little difference. The extra release still comes under MCOBs. Financial circumstances not being given sufficient weighting. So if the client had sufficient surplus income recorded, but it had little or no bearing on the final recommendation, which solely focused on the client's preference for making no monthly repayments. So if the client can afford the mortgage, then why aren't they paying it? Detailed documentation. That's not to say there won't be reasons why you won't go down that route, but you've got to make sure it's clear, because if somebody picks up this file in 5-10 years' time, it's not going to be clear to them why the client didn't go for what would be the more conventional, less risk option. And then you look at advisors' recommended changes to property ownership. So removing joint owners who was too young to meet the requirements from the title deeds to allow the extra release take place. Obviously, without sufficient discussion of the impact of the long-term impact of the change of ownership. Because obviously, if you change the ownership of the property, that could have inheritance tax implications. Yes, it means the extra release can be granted, but actually, what's the longer-term impact? Now, again, we see a lot of extra release advisors coming from the mortgage market who maybe don't understand the IHT implications quite as much as somebody who works in that market. So just ensure that if you are doing something, that you've considered the impact, and not necessarily the impact that you're aware of, but actually talking to specialists in that area. So if you're part of a wider firm, talking to advisors who know the inheritance tax market. If you're not part of a wider firm, taking advice, really making sure that what you're doing isn't going to have a bigger impact in the future. It wouldn't be that you've done it deliberately, it would have been done it through ignorance. So actually not understanding the impact it's having doesn't make it any less wrong. So really making sure that if you're doing something, you've looked into all of the options and all of the implications. So the next part then talks about the need to challenge customers' assumptions. So we talked about this in a second, in a bit here, but actually really understanding why would you go into something without fully understanding what it is you're going into. Now, clients will do this on a regular basis because they've come to you for advice. So they're expecting you to challenge their assumptions. But in reality, this is down to advisors, rather than going for what is potentially the easy option, thinking, well, extra release works, let's go for that, really breaking it down and challenging those assumptions. Really key that happens. Something that we've seen a number of firms start to do is to have a specific, questionnaire that clients complete, which demonstrates their understanding of what they're doing. Again, that's not dissimilar to firms that work in the defined benefit market who've done a similar thing where they now need to be able to demonstrate that the client understands what they're doing. There are a number of ways of doing this. But obviously, in the absence of robust advice, it could be easy to sell a product that on the face of it has no immediate cost, so no monthly payment, releases the cash lump sum that the customer wants. This makes the role of the advisor to ensure the long-term implications are considered again. So really make sure that the clients understand what they're getting into. Obviously, accepting advice that a client thinks is going to be right for them without really going into more detail will have a huge impact on the longer term of this. So the question that's just come in here, part of this, and I guess this is just part of that conversation a second ago. Rob said, I see advisors including the residential nil rate band, but do not consider extra release loan as an offset, i.e. you can't have both. So again, do you as an advisor understand what the residential nil rate band means, how it works, and what impact having an extra release loan would have on having that? Because as Rob says, you can't have both. You either have it or you don't. So for those of you that don't know what it is, let's have a conversation. Let's talk about what you would need to do to understand, I guess, that side of things, or if you've got someone in the business that you can talk to, then make sure you're referring these questions across before they go ahead. Again, challenging assumptions. So this is a big factor for us. I get it. We all use templates when it comes to documentation. It's by far the most efficient way to do something rather than rewrite something fresh every time. but too many points that are in there are generic and are not personalized to the individual. And we see the same 4 discussions or same 4 points, 5 points, whatever it may be, on every single suitability report. But actually, when you look at it, 1 or 2 are only actually applied to that client. So for us, when you're looking at advantages and disadvantages, which is a really good way of looking at this, they should be very, very personalized to the client and their circumstances, rather than being generic risk warnings about a product. We see this across the board, but it's very, very apparent within equity release that these are generic statements, rather than actually, at client's own words. So what the FCA have said is, and we agree with this, is use the client's own words, use the phrases, use meeting notes, anything that you can that demonstrates the client's done this. So again, back to my point a second ago about using some form of questionnaire. A questionnaire that has a client needs the client to write out their answer rather than ticking a box that says which answer applies to them. That will be A, you get in the client's own words, B, demonstrating they actually understand what they're doing. Because if they can't articulate the story or the conversation you've had, then potentially don't understand it. If you've got a situation where you've got a vulnerable client who maybe struggles, with writing or whatever it may be, then again, ensuring you've got another party as part of that meeting. So making sure there's somebody there that can articulate the story in such a way. If you can't have somebody there or the client doesn't want a family member present, record it. So record details of the client meeting and actually, I've got here in terms of recording details of the circumstances, soft facts, context, but actually the FCA came out and said, record the meetings. Have a recording of that meeting. The technology is available. For those of you who use some of the bigger back office systems, the technology is available within it, or you can integrate it with some form of recording and you can drop it straight in there as a meeting note. At worst, I would suggest having a colleague in the meeting with you, taking some notes, so that there is a third party who is taking notes rather than you trying to take notes whilst talking to a client. But obviously, the ideal here is inviting family members, beneficiaries to the estate to be present at the meetings. Such a key thing. We see a lot of firms now insisting that happens and insisting that family members receive the suitability letter before anything goes ahead. So again, it's been understood before any decisions are made, exactly who was party to this and who understands what's going on. So, I think there are so many ways in which we can do this, but I think at the moment, potentially this area is being given lip service. And I think our firms can do a lot better without really having to do much because the conversations are already happening. It's just documenting it and recording it. And obviously from a client's perspective, you can demonstrate that you're looking after their best interests. So there shouldn't be too many objections or challenges from clients about this. So how did the FCA feel that evidencing suitable advice would look? So suitability letters that are clear and easy to understand, not pages and pages of templated information. So they actually came back and said they were looking at suitability letters that ran to 20 pages or more of containing exactly the same information on every single report. So nothing that was personalized to the client. Information you felt was necessary for a client to make a decision, but the reality is they didn't get to the bit that was really important, that was maybe on page 21, because they'd got bored with the generic information on page 20. The suitability report should be a confirmation of what you're doing and why you're doing it. Anything that was needed prior to that should be given to the client prior to that, and it doesn't need to be duplicated. Suitability reports should be provided prior to submission, so they shouldn't be done after the event. And ideally, as we talked about, is shared with family members to ensure we've got a collective understanding of what's being done and why. And then clearly labeled risk warnings and the client's own words and responses. So again, if you've got a section, if you've had a conversation with a client and you've got their own words, get it written down, get it put and put it back to them that this is what you said. I asked you this question, these were your answers, so that any challenges can be dealt with at that point. In terms of suitability reports, I completely appreciate that they seem to be getting longer and longer and longer. That's not to say that you can't tweak the way they're written. So for us, we quite like seeing all of the really key information up front, anything that was discussed, anything that should be the client needs to understand at the very, very start of the report, anything that's there in terms of, I guess, protecting oneself, I'll put, given this is being recorded, can be at the back in an appendix. So if there's something you feel is necessary on file but isn't pertinent to the actual piece of advice that's being given or the client conversation you had, then an appendices will work. But having it structured where actually the really important stuff is at the back, It doesn't help if it comes to a complaint, because the FOS will say the client didn't read it, and you're saying, well, it was in the report, and the client said, I didn't understand the report, and FOS will likely agree with them. So, this is what we see day in, day out. So just get it really clear, get it really simple. Think about the language you're using. Yes, it's got to be professional, but equally it's got to be understood by the client. So let's just make sure that's exactly as, as you're trying to produce it. So the FCA then talked about a few next steps. So what did they feel the next steps would be in terms of getting this right? They've come out and said that actually they're going to continue to increase the supervision in this area. So because of the findings and the concerns they've increased the number of supervisors. Obviously, COVID had an impact on being able to do some of this work, but they've increased supervision in the area, and they're going to continue to see this as a big focus and a key focus, especially around the point of vulnerability. So, they've got a big piece of work at the moment in terms of assessing vulnerability and how firms document that. This forms a big part of that, but it also forms part of a bigger piece, which is the individualization of the advice. So the personalization of the advice rather than the generic nature that we talked about. Where they find poor quality of advice is being provided in the market, then they'll take action. So they'll either restrict permissions, they will request far more information on a far more regular basis, but either way, the supervision that firm and the advisor will receive, and it will be at firm level, will be increased dramatically. So if you get the information request, which is one of those horrible emails that you get on a Friday afternoon that says, we'd like your new business register, we'd like all of these details, we'd like to see a T&C scheme, we'd like to see the CPD, we'd like to see XYZ, and by the way, we'd like all of this within the next 10 days, that's what you will receive from the FCA, and that information is then provided to them, and then you've got a waiting game to see what the outcome is. If the outcome is that actually they feel the advice isn't where it should be, expect a phone call and expect a visit and expect a project to be put in place in terms of how you demonstrate that you are actually right to be in the market. Obviously, the effect of COVID on people's finances have reinforced the findings, not changed them. So they made a big point about this in terms of they feel this market is increasing because of the impact that COVID's had on people's finances, seeing more and more people. And Ash talked about this in terms of gifting. Now that could be gifting for IHT purposes, but it could be gifting because actually somebody's children have struggled massively during COVID, and the parents are saying, well, we've got the money tied up in our house, we'll help you catch up with your whatever's happened in your life. So this market is only growing, and the regulator is aware of that. So don't expect things to slip, expect things to get tighter, not easier. So the actions for firms, and I guess to talk about where we take this in terms of what you can do to move forward. Firms need to ensure that they take reasonable steps to obtain sufficient information and provide customers advice. So I think this is the key point here, and this is the step up that's required now from where things were at. When given advice and to enter and extra release transactions for the first time or subsequent time, firms should ensure the advice is suitable. So again, this is really going that extra step with regard to demonstrating what other options were considered and why this is the most suitable option for the client, rather than being the only option that was on file. And then firms ensuring they collect and retain the necessary evidence to support the assessment and the suit of the advice. So this is where the file is going to need some extra work. Too often when we read files is we don't actually disagree that the extra release is the right option. It's very difficult to understand how you arrived at that decision because the meeting notes don't exist. The fact finder has big gaps in it. There's no expenditure or budget. There's no real client objectives. There's no breakdown about, the family. What future inheritances could the client be receiving? Stuff that, in reality needs to be on file to be able to demonstrate that this is the most suitable product for the client to have to meet their objectives. And that's it from me. I'm finishing slightly early. So if anybody's got any specific questions for me right now, then please ask them. Otherwise, I think Tom's going to join us in a second, and he and I can start having a bit of a Q&A. Morning, Tom.
Morning. How's it going, guys? Yeah, well, I don't know. Do you want to wait for questions from everybody else?
Yeah, let's see. If anybody's got any questions, either feel free to put them in the chat, or please, by all means, put your camera on, and let's have a conversation. No? Okay. Oh.
Perfect. That's fine. Well, I think that was really great, Christian, and also good for me because I've had a little bit of peek behind what the compliance side of things is rather than from the insurance side. So they marry up quite a lot. And I just want to kind of give a brief overview of myself and how what you are purporting and promoting is going to help with the professional indemnity renewals. So this is my 10th year as a financial lines professional indemnity broker. So that's what I specialize in. I've had 2 stints previously at larger insurance companies as an insurer. But as exactly just to piggyback on what Christian said, as this is an area of growth, it is going to be a point where there is going to be a spotlight turned on it. And the regulations and the restrictions are going to get more fervent rather than having a more relaxed approach. And we've seen this over the last 5, 6, 7 years when it comes to interest-only mortgages, when it comes to defined benefit transfers. As soon as the claims management companies see there's an area of growth, they turn their attentions to that area, and that's where they see where we can exploit. We know, and we've gone through this with obviously many of our clients, when we have somebody who has a professional indemnity policy that has restrictions or exclusions, we have to go down the route of, well, you need to note this on your Gabriel return. And that Gabriel return, sometimes then it might have a point where the FCA go, right, your excesses here are higher than the normal. Is there a reason for that? Have you got an exclusion on there in regards to certain elements of work in regards to equity release? Have you got no coverage at all? What is your past liabilities looking like? And you have to go through a dispensation process at times. We've gone through this dozens of times with other firms, especially in relation to defined benefit transfers, which was the big one. And a lot of the times the FCA come in and say, well, we're going to remove your permissions for that element of the work. And also, we're going to put additional capital adequacy requirements in place for you because of the additional exposure that you have for your clients without having the relevant coverage in place. So it's evidently clear that the compliance side of things really, really now marries up with the professional indemnity policies more than ever. Because I'm sure the people that here that have had policies in place and have been in this business for a long period of time have suddenly seen the amount of information that is being requested of yourself is ramping up on the professional indemnity side, especially in relation to renewals, purely and simply because the spotlight has turned on this. It used to be 4 or 5 years ago, you'd fill out a 3 or 4 page form. Me as a broker could go to 7 or 8 markets, get 3 or 4 sets of terms, and put them together and say, well, let's negotiate from there, which is the best possible pricing. That was in a softer market, obviously. It's hardened over the last 4 years. Equity release is now the next on the hit list, I would say, in relation to FCA authorized businesses. And obviously, due to the growth, we're having it where we are trying to work with the council to try and have an education on not just your side as the firms, but also from the insurer side of things as well, because you might have seen in some of your professional indemnity renewals, there has been questionnaires put forward now, exactly as Christian has alluded to, where it wasn't asked for before. These questionnaires have evolved over the last 2 years, where they were 6 questions long. The latest one that I've just seen released is 15 questions long, with sub-questions involved in that, additional questions and answer sheets put on tagged along with that as well. So it's just going to be a level where it's just going to get to the point where the scrutiny of the side of the equity release is going to get to a point where you guys are having to, if you don't have the processes, the CRM systems in place to actually be able to draft this information up and be able to put it forward to the insurers, they're going to have a question mark of why can't you provide how many home reversions you've done in the lifetime of the company, which is always a tough one because everybody uses different systems. The vast majority can't bring that up. So what we've tried to do is speak with insurers and say, right, we can't have it where you, for example, can advise and confirm that at every single equity release, the beneficiaries are part of the process. I know obviously Christian has advised that some firms are now saying the suitability report and letter has to go through to the beneficiaries, but at the end of the day, and I know that's rare. At the end of the day, your client, it's up to them. It's their prerogative whether they actually advise their beneficiaries or not. A lot of people, it's my money. That's it. So a lot of these questionnaires are asking, can you advise and confirm that on every single equity release transaction that the beneficiaries are part of the renewal of the process and are advised. You cannot say that unless you have a very, very robust system and very, very stringent processes in place. You cannot confirm that without any without any question mark on that. So what we don't want to do is you confirm that, we get to a position where you have a claim, then, because the claims always come when unfortunately when somebody passes away, the beneficiaries say, wait a minute, I didn't realize that this property had 30% sold, or I thought that my mum and dad were fully were mortgage free, or whatever the case may be. That's when the claims come through. Oh, did you not know that my mum was actually suffering with Parkinson's towards the end of her life? Did you not know that she had dementia? It goes on and on and on. So what we don't want to do is somebody confirm that. It comes to a claim. The claim comes through, and the beneficiary said, "I was never advised. I was never told." So that's the piece from our point of view where we're trying to teach the insurers. We cannot advise this at the time. The insurers are people as well. They are coming into this on a reactionary measure, I would say, where they are being led by the FCA, the claims management companies, and also the solicitors and their actuaries, saying, look how much you've got on your books. This is how much exposure you've got. This is where the growth is coming from. This is where the claims have risen in this certain area. So now we've got to the stage now where we are thinking, right, we need to advise and educate from both sides, and more is definitely more here. That's definitely the way forward. I know that certain insurers now are putting restrictions on policies, and again, Christian touched on it. Equity release in relation to mortgage, in relation to property purchases and investments, and we understand the benefits of it from our side, and we think that's a common sense approach in certain areas. But some insurers are not happy with that, and that's because has it been done in the right measure previously and in the right documented in the right way, because that's where some of the claims are coming from. If you actually look at the FOS complaints with equity release, they're actually relatively low, and that's when we've been speaking to the council and some compliance of companies and so on and so forth. They've always said, right, well, if you look at actually the FOS complaints, they're not actually that high when it comes to equity release, and that is purely and simply because the insurers are settling before it even gets to that point. There's a lot of claim reserves, claim settlements that are being put on. As soon as they get something in, they put a maximum probable loss on there due to obviously their actuaries and their projections. And a lot of the times it's a commercial settlement. They go, right, well, the suitability report or the file that you provided us doesn't put us in a position where we can actually protect and defend our position at all. So they're settling out, and that's happening more and more. Some of the insurers that we're dealing with are saying that if you do not have a file in a durable and an indefinite time on file for them to actually be able to provide a defense, a mounted defense, then they're not going to cover you. That one insurer has taken that stance. They've said if you cannot provide a durable file, our argument from that point of view initially was, well, GDPR. How long do we keep this file in place? Do they have to keep it in place for 10 years, 15 years, 25 years? How does it work? They're saying now indefinitely, and certain insurers are now putting that into their restrictions and saying, if you cannot provide a file for us once a complaint comes in, then we're not going to provide coverage for it. So it's something to consider when you guys are thinking, right, well, actually, guys, it's been 12 years since we last done this. The answer is it's up in the air whether we can or cannot put a time on it when it comes to what the insurers want. They're putting indefinite. That's the wording that they've decided to do. There's 2 insurers that are now doing that. So what we get from a piece from our point of view from education, we want to make sure you guys are understanding that it's not the same process as a few years ago where you fill out a form. We want you to go into details of, do you have the processes in place? Do you have vulnerable client policies? Vulnerable client policies, we don't want them just to be about sound of mind, as Christian put on. Is it their second language? Do they have struggle seeing? Have they got eyesight issues? Should you bring somebody else in? And I think now we're kind of getting to the point where risk mitigation that we can put forward to insurers is paramount. And if we can get to the stage where we say, right, well, look, this firm's actually thinking about this. They have got all these procedures in place. They're doing it to the guidelines. And they're exceeding those guidelines, and this is how they're looking at it, and they are constantly evolving and reviewing their policies in place. They are looking at every year. They're providing ongoing advice. If we can get to that stage, then it's a better story. It shows attitude to risk, and insurers now want to know a lot more about the details and the inner workings of a firm, and compliance is key to that. Yeah, we get.
Tom, you've basically just led us straight into my first question for you, which was almost like we scripted this, but we haven't.
Yeah.
In terms of how firms get those processes in place, so one of the questions that I had for everybody actually, but is, as a result of what firms have seen today, both from the provider and also from me and then your part here, is lots of firms were going, we thought we were doing it right, but actually we need to up the ante here. We need to, there are a few things that we need to work on. The Equity Release Council is providing some really good guidance here, isn't it? In terms of what they feel good processes look like and how things can be done. Any guidance for you in terms of how firms can kind of take that next step as to making sure that what they're doing is going to cut the mustard if the insurer asks for it, and actually as part of the renewal?
Yes. Okay, that's great. So yeah, the Equity Release Council are putting forward guidelines. They are constantly evolving and changing what they're putting forward and trying to make it more robust. We're trying to work with them and insurers so they can get ahead of the curve. So we speak to insurers and say, right, over the last quarter, where have the claims come from, where have the notifications come from? And if it's something that hasn't been, because like I said, the Equity Release Council only really get the false complaints rather than the settlements of the insurers. So we say, right, this is where things are coming from, and this is an ongoing process now. The equity release in relation to property purchases is something that they were like, oh, we didn't realize that was going to be the case, why that was an area of concern. So they're trying to get ahead and say, right, what can we put in place to make this a little bit more robust for the insurers? If I'm honest with you, with our conversation with insurers, some have taken the stance, who have written it for a long time, and said, we're really not looking to grow this element of our portfolio anymore. It's not quite as severe as the culling that we had with the defined benefit transfers, when some people were saying, well, we're pulling the plug altogether. Insurers are still now saying we're looking at it on a case-by-case basis, with some others are taking a more common sense approach, where they see if it's done correctly under the Equity Release Council guidelines, and obviously with the help of compliance, they can take a socially responsible stance, because at the end of the day, this is a socially responsible business, in the ways that if you've done ethically, it works. And it is going to be an area. There's a reason it's going to be an area of growth. So I think from that point of view, it is going to be, unfortunately, a bit of a moving feast. We are going to be a bit more reactionary than probably what we'd like to be, but we are in conversations with insurers to say, right, the last quarter, was there anything that you didn't see coming in regards to notifications? Is there any way that these claims management companies are being a little bit smarter, or attacking it from a different angle? And from that point of view, we're trying to feed that through to the Equity Release Council, so that has a knock-on effect to the guidelines. And from our point of view, then we can say at renewal, by the way, they've done this. And also, if you haven't been doing something, and this is always the thing where we go, right, well, Tom, we haven't been doing that. That's fair enough. That's fine. Let's have a look at the claims history. Let's have a look at the burn rate in regards to the insurance premiums. And then what we'll look at there, we'll go, right, when we speak to the insurers, we'll go, this is what they've put in place for risk mitigation going forward. Look at their attitude to risk. This is what they're trying to do. They're trying to get to the point where these guys believe that they are providing high level and applicable advice in a specialist area. So that's kind of where we're going at with it. I know obviously you mentioned in regards to insistent clients. Unfortunately, that really has been a bit of a bugbear. If we are talking there is a small percentage, then yes, okay, that's fine. If there's reasons for it, and normally that's down to medical reasons. If somebody is in poor health, sometimes that does make sense. If, for example, that seems to be a trend within the business practices, then it does seem to be causing some real issues with insurers. And we have had it on multiple occasions where they do turn around and say, right, we're going to exclude any claims coming from assisted client basis, unless otherwise accepted. So that's why we say, right, well, let's ring fence these 8 that were done in relation to poor health, and these are the reasons for it. But a lot of more information has to go through to that.
No, it makes sense. And just back to the point, so a couple of points you made there, which I think are really important. And this goes for the regulator as well as the insurers. If a firm's noticed they haven't done things as well as they could have done, but have then put the systems and controls in place, that actually shows good governance. You know, that's ironically what the regulator wants to see. If you know you've not done something well enough and you either ignore it or you don't do anything, or you don't notice it in the first place, that's a real problem. Realizing you can do things better and you've put the systems in place to do that is actually a really good thing, and it demonstrates to the insurers and the regulator that you are looking at your business on a regular basis. I think the other part there, Tom, is that, you know, this is a constantly moving feast. So we are going to be putting these events on a regular basis. And obviously the idea then is we'll get market commentary. What's happening? What have we seen? What are we seeing from the regulator? What are you seeing from the insurers? What's the Extra Release Council seeing in terms of FOS? All of these things together so that firms can look at their process on a regular basis. Something we're doing a lot more of, and again, this comes back to, and I hate to keep on saying it, defined benefit, but we've helped firms for years put together really robust defined benefit advice processes. We're now doing exactly the same thing for after release.
Yeah.
How do we do this right? You know, Ray, you've asked a question around the fact, you know, will advisors only be giving bread and butter advice and outsourcing anything that's slightly contentious? There shouldn't be any need if you've got robust systems and controls in place to demonstrate you are doing these things that we've talked about. So there shouldn't be any need to it unless, and I know that's not the case for you, Ray, you try and kind of do a one size fits all and say, well, this is our advice process and we're going to follow the same thing for everything. Whereas actually, when you start stepping into more contentious areas, then you've got to make sure that you up your game. So I don't think there's any reason for anybody to kind of, you know, remove themselves from the market, but I think everybody should be looking at their advice process to ensure it is robust enough to meet the requirements we're talking about. You know, yes, it might be a big piece of work. It probably won't be, but let's make sure we've dotted the I's and crossed the T's and actually thought about the implications.
Yeah, 100% agree. I think when it comes to, when I talk about going back to the education of the insurers as well, I think a lot of the insurers, because they're coming to this to this relatively, like I said, reactionary, a lot of them didn't really realize that certain things, that measures were in place. So when we started sitting down and saying, well, actually, do you know that this is in place and this is in place, the sound of mind checks for the solicitors, the fact that full suitability reports are put in place, and the detail of them, because what I always do get from one of my, if I go into market, I'll get a sample suitability report and say, look, this is the details that they go into. We're not talking a 1 or 2 page here. These are the full details. Yes, you can see that they are advising that their advice would be that beneficiaries are part of the process. Kids day one, as one of my advisors always says. But the problem being is that's not always possible and not always the case. So as long as we are doing, or you guys are doing everything your power and saying, right, well, these are the advice we're giving, this is the reason why, look at what we've done, look at the triage process that we've gone through, this is the reason why we believe this was applicable to this person at this time, then yes, we can say to the insurers, and it's not all doom and gloom, and it does feel like that's been my job as a Grim Reaper for the last 4 or 5 years, but it's not all doom and gloom. Yeah, true. But we do have we have had and we do have a few markets that look at this and go, no, we understand it. Yeah, we understand why they're doing what they're doing, and we understand why there's a level of growth, and we understand that it's going to continue to grow over the next 3 or 4 years. So it's not like everybody's running scared. A few are, and I think again, which is always the frustrating thing from our point of view, and this is why we'd like to try to get involved at such an early stage of a trend starting to in regards to growth, is insurers are always reactionary, and they also try to sometimes see what everyone else is doing. What are they putting on in regards to restrictions? Oh, right. I wonder why that is. It's herd mentality. Yeah. So that's why the education piece at the very start of this boom is paramount, because if we can get somebody to say, no, we understand, we think it's a socially responsible business, That fits in with our ethos. If somebody's following these guidelines that you've told me that they'll follow, then why not? So we're putting together a declaration that says if you do follow X, Y, and Z, which is a buy-in from you guys and saying yes, we do this, and we'll do this at every renewal. That might evolve as always, but at least then that gives the comfort and the handshake to the insurer. Yeah, I am following these guidelines. And then it gets to the stage then where if they're happy with the guidelines put in place and they're happy with the involvement and the policies in place as well, there's no reason why you should be walking away from this business. It has felt like that larger companies, bigger businesses have been given more preferential treatment in the past, where it feels as though maybe potentially insurers and the FCA are focusing on bigger business because they believe that they have more robust processes in place. They have the infrastructure, they have the dedicated compliance team, so on and so forth. However, that we can demonstrate in the right way to insurers.
100%.
Right, yeah, we can do that. So that's not the problem. It's all about making sure you get with the person, broker, or you educate your broker. Even if to get to the point, and some insurers will do this, to manage expectations, it will be at certain premium levels, but some insurers, and we've done this several times, will have conversations like we are here with Christian. We'll get on a Teams call with an underwriter, and rather than it being an impersonal, send email here, back and forth several times, let's get on a call with somebody, go through it. Let's see if we can answer the questions on the phone, make everybody comfortable with what they're doing in regards to the insurances, and then get a turnaround from there. So yes, it's not all doom and gloom. We have options on the table. It's not going to get to the stage where everybody's going to have to stop doing equity release. I think the FCA are getting to the point where they understand why this is happening, and I do think there is going to be a bit of a focus on it, because they do seem to a bit of a lily pad jump from the next trend to the next.
Yeah.
And that will be a point where you guys have to you might have a bit more scrutiny on this level. But if we can get you terms without restrictions, or not on a high excess level, that's linked to equity release, then the behavioral return should be very, very straightforward. It gives you the protection. What they're worried about is a restricted policy or a very, very high excess level, because as you guys know, it would almost certainly be on each and every claimant basis. So if they insurers or the FCA see, right, we think there could be a systemic problem here, and you have 5 or 6 claims coming from a claims management company, that excess is applicable to each risk, to each claimant that comes in. So what you don't want to be stuck with is a 25,000, 20,000 excess, which I know some insurers are putting on equity release, which is not plausible for certain size firms, well, for most firms, to be honest. And then you get 6 in from the claims management company because they've rounded up. Oh, do you know anyone else that uses this company? You get hit with 6 notifications. You've got a 25,000 excess. That's 150,000 before the insurers will actually pay anything extra in regards to the settlement. We don't want that. The FCA don't want that, because they don't want you guys to be drowning. So that's why, if you have a high excess, if you have restrictions, if you have exclusions, that's why they're looking at it and saying you need to put additional capital adequacy in place to try and prevent or provide protection for your clients and yourselves at that time, if that were to be an eventuality. But yes, that's why we're trying to work with people and say, right, equity release, we still believe to be low risk if somebody follows the right guidelines and is following the right measures.
Question for you then. Let's end on a positive in terms of how firms can get this right. And this is a question that came in from Rob, but it's one I already had written down for you. And obviously, as you say, you've provided some sample suitability reports to insurers as part of renewal. You and I have talked about what good looks like. Have you got any examples? I've got a few, but have you got any examples of what good practice looks like when it comes to suitability reports?
Yes. So you've kind of touched on it already in regards to your slides. It is directly quoting the clients. So that happens a lot of times. We've had a few claims where somebody said, well, my dad wouldn't have done this in sound minds, and they've quoted what the person has said, and they go, oh right, yeah, that my dad does. that is my dad. That is what my dad says. So putting in the personal factor as well. The meeting notes are obviously, if you can have a third party, that's absolutely brilliant. That gives that extra line of defense if something were to come through. I'm not an expert from the compliance side of things. Obviously, that's your forte, Christian. But from our point of view, we can say, look, they've outlined in layman terms, because not everybody's a sophisticated buyer, especially in this element of it. Defined benefit transfers, the argument and a lot of the claims came from, oh well, these guys weren't sophisticated buyers. They didn't really know what the repercussions were going to be. Equity release is going to be the same thing. I think equity release is going to be a more of a broader stroke, because you're not going to have people that have defined benefit transfer pensions. So I think the sophisticated buyer side of things, it needs to be in clear, concise words that they can understand, and also the fact that we can note in there, yes, this is our advice in regards to, I know I've banged on that drum in regards to the beneficiaries. This is our advice, that you advise the beneficiaries of your estate to advise them that this is going on. If we can make that clear, if we can demonstrate that this is the best option for them, that other options have been reviewed, small payments versus long payments, home reversions versus obviously one lump sum or salary or both, or whatever the case may be. If we can show suitability side of things, that the insurers can have a look at that, and we can say, right, look, they are taking the time to do this. It's the same as what's happened with our industry, insurance brokers, with our demands and needs. It used to be, and I'll hold our hands up, 5 years ago, it used to be, we had a demands and needs set, and we said your demand and your need was to have professional indemnity up to this level to cover your business as a mortgage broker or a financial advisor, whatever the case may be. And in the recommendation, it said, we are recommending this because it fits in with your demands and needs. It's with a competitive premium. It's with a major insurer in this thing. It's got this. We can't get away with that anymore. We have to put the questions that we've asked, the decisions that you guys have made, the reasons why we're putting through what we've heard, what's been important to you, what other areas of insurances that we've spoken about, whether you took that advice or not. Because what we don't want to do is, you're only as good as your suitability report and your file. And once a claim comes through, and if you cannot get to a stage where you guys turn around and say, well, no, and this happens very, very often, it's like, but I did have that conversation. It's unfortunately what you can prove, which is always
there's the age old, and I hate saying it, there's the age old rule in compliance: if it ain't written down, it didn't happen.
Yeah,
it's as simple as that. Rob, I think there's a lot there, but I think specifically in terms of suitability reports, I think the idea of using things like longevity examples and ONS showing what the outstanding loan in 10 years or 15 years, yeah, absolutely. I think for me, it just comes back to that personalization. What's the client trying to achieve, and why have you decided this is the most appropriate option for them? And then to document how you've arrived at that decision. Doesn't all have to go in the report. This could be research on file. This could be anything that you've got that demonstrates how you've ended up at that result. But just making sure you've got that personalization and really, really talking about, why you've done what you've done. I think if you can get that right, you won't go far wrong. But I'm more than happy to have a conversation around kind of how to structure a suitability report. We've got some examples in terms of what good looks like. So yeah, very happy to have conversations with people.
Yeah.
I don't know, can you hear me?
Yes, we can hear you.
Oh, sorry, just because I've got a dash in a minute. But one of the other things you mentioned, that at the moment there haven't been that many claims. I think it's a bit like wills. These things don't come to light until somebody dies, so I think that we'll be starting to see more of those cases once.
I agree.
Yeah, definitely.
And obviously that's the insurers are thinking the same.
That's a good point. Yeah, I know that some of the actuaries sit down with the insurers, and we always say, well, we've been told that we've got 30% of the equity release business in the nation at the minute, and we need to de-risk, and we need to bring this down to more like 15%, purely and simply because if it does go pot, we don't want to be on for 30% of the claims, because this could mean X, Y, Z. And actuaries are always worst case scenario people anyway. I think that's their job. But I know this is I'm trying not to say insurers' names and cast aspersions and so on and so forth. So if anybody wants to have a more personalized conversation about who they're with, what's that looking like in regards to renewals, then please feel free to call me or send me an email, and I'll be happy to to provide a little bit more of a bespoke
Absolutely.
response.
And the same thing, if anybody wants to review their extra release advice process, more than happy to have a conversation. You know, let's sit down, let's go through what good looks like, let's go through what you're currently doing to see whether we can find any areas that can be improved, evolved, whatever you want to call it, to make sure that you're keeping pace with what the insurers are expecting and what the FCA is expecting, because both are going to be equally important.
Yeah, Rob's made a great point there. Like you said, these people haven't actually passed away, the bulk, so that's where the claims are going to be coming from. So yeah, that's great. Well, thanks very much, Christian. That was really helpful for me as well. So
thank you. Guys, anyone else got any questions before we finish up? I know we're slightly over time, but I'm conscious that if people have got questions, then let's answer them. No. Okay. Look, I really hope this morning's been useful to you. We will be getting you a feedback form out immediately after the event with contact details on it as well. If you'd like your CPD certificate for this morning, then please just complete the feedback form, get it back to us, and on the back of that, you will get your CPD certificate for the couple of hours we spent on here this morning. But if anyone's got any personal questions or any individual things, please just pick up the phone, drop us an email, do whatever's necessary, and yeah, let's take the conversation further.
brilliant. That's great. Thanks, Christian.
Thanks all. Cheers, Tom.
Cheers. Bye.
Take care. Cheers now.